In the cycles of history, in the swings between boom and bust, in the rising tides and falling waves of economies, there is a pattern that repeats itself over and over again. It is not new. It is as old as capitalism itself. And yet, every time, most people fall into the same trap. They make the same mistake, especially when a recession hits. The worst investment mistake people make in a recession is thinking emotionally instead of they get caught in what I call the first order consequences mindset. When markets fall, people panic. When asset prices decline, fear clouds their judgment. They extrapolate the recent past into the indefinite future. If stocks fell 20%, they believe they'll fall another 20%. If their neighbor lost his job, they fear their next. In that emotional fog, people sell what they should be buying and hoard what they should be deploying. You have to step back and see the machine. Economies operate like a machine. Credit expansion leads to spending, spending fuels income, income fuels further credit, and the cycle continues until debt burdens become too large. Then deleveraging begins. The central banks intervene. Fiscal policy adjusts. The machine corrects itself. Recessions are painful but normal parts of this self-correcting system. But most people don't study the machine. They react to the pain. The mistake is deeply rooted in human nature. Our brains are wired to avoid pain and seek comfort. When portfolios shrink, when headlines scream crisis, when uncertainty dominates, our instinct is to retreat, preserve capital, wait for clarity. But in the markets, clarity comes after the opportunity is gone. By the time the economy looks healthy again, asset prices have already recovered. The market leads the economy, not the other way around. This mistake is amplified by a dangerous illusion, linear thinking. People assume that because conditions are bad now, they'll get worse linearly. They fail to appreciate how markets are discounting mechanisms. Prices embed expectations. In a recession, markets are already pricing in bad news, sometimes even worse than reality. That's why some of the best long-term buying opportunities emerge at times when the news is terrible, when earnings are falling, when layoffs are accelerating, when GDP is contracting. The greatest investors, the ones who compound wealth through cycles, are the ones who see beyond the first order effects, who understand that markets move based on changes in expectations, not absolute conditions. When most people invest, they do so with the intention of achieving security, growth, and peace of mind. Yet, paradoxically, the very emotions that drive them toward investing become their greatest liability during the most critical times, particularly during recessions. The fundamental problem lies in the way the human mind responds to stress, uncertainty, and loss. We are wired to respond to immediate threats. Our evolutionary biology favors survival instincts that served us well when faced with physical danger. But markets are not saber-toothed tigers. The same fight or flight response that kept us alive in ancient times leads us to make devastating investment mistakes when markets turn down. In recessions, prices fall, businesses struggle, unemployment rises, and fear spreads like wildfire. Investors watch the value of their portfolios shrink, and every headline screams crisis. The discomfort becomes visceral. Every instinct pushes them to act, usually to sell, to retreat, to avoid further pain. This is the precise moment when their emotions override their logic. They focus intensely on the immediate pain of losses, ignoring the long-term trajectory of the economic machine. They confuse volatility with risk. They see falling prices as confirmation that the situation will only get worse, rather than recognizing that prices reflect not just current realities, but also expectations of the future. The mistake becomes self-reinforcing. As people sell out of fear, they drive prices even lower, confirming others' fears and causing more selling. This is the feedback loop that fuels market panics. Rational analysis gets drowned in the collective noise of emotionally driven decisions. And yet, time after time, history shows that these periods of panic are precisely when the seeds of future gains are sown. Markets overshoot on both the upside and downside because of these emotional surges. One of the greatest disciplines an investor must develop is the ability to detach emotionally from these swings. It requires seeing markets as probabilistic systems driven by cause and effect relationships rather than as reflections of current emotions. The disciplined investor studies history, understands cycles, and recognizes that recessions, while painful, are necessary adjustments in the broader economic system. They create rebalancing forces. Bad debts are written off, excesses are corrected, productivity eventually improves, and growth resumes. The irony is that during the boom times, when everything feels safe, most people take on too much risk, believing good times will continue indefinitely. Then, when recessions hit and prices drop, they flee from the very opportunities they once craved. The herd mentality drives them to buy high and sell low, the exact opposite of what produces long-term wealth. The emotional mistake is not made during the recession. It is made long before, by failing to anticipate that downturns are inevitable and by not preparing psychologically and structurally to take advantage of them. To avoid this mistake, one must adopt a posture of humility, knowing that cycles are larger and longer than any one moment of panic or euphoria. Preparation, diversification, and a clear understanding of how the economic machine works provide the foundation. But above all, the investor must master the inner game, the battle against fear, against short-term emotional responses, and against the overwhelming pressure to conform to the crowd at precisely the wrong time. This mastery is rare. That is why few achieve extraordinary investment success over multiple cycles. But those who do consistently profit from the mistakes of others who let emotions drive their decisions when it matters most. If you want to navigate markets effectively, you need to stop seeing the world as a series of isolated events and start seeing it as a system, a machine. Most people look at the news, watch the stock market rise or fall, listen to commentators, and react to the latest data point as if it's a standalone surprise. They are trapped in what I call the sequence illusion, where each event feels disconnected and random. But the economy doesn't work that way. It operates like a well-dimensioning machine with interconnected gears of credit, spending, income, investment, productivity, and policy. Understanding how these forces interact is the key to making sound investment decisions, especially during recessions. A recession doesn't just appear out of nowhere. It's typically the result of an unsustainable buildup of debt and excesses that have been allowed to grow during the preceding boom. Credit fuels spending. Spending increases income. Income allows more borrowing, and the cycle feeds itself, driving asset prices higher. Eventually, debts grow faster than incomes, and the burden of servicing those debts becomes unsustainable. At some point, lenders pull back, borrowers struggle, and the economy contracts. This contraction, this deleveraging, is what we experience as a recession. But it is not the end of the machine. It's simply a necessary rebalancing process that corrects prior excesses. When you see it through this lens, a recession becomes far less mysterious. It is not a random accident, but a predictable consequence of prior actions. And because policymakers understand this, they too act according to their incentives. Central banks lower interest rates to ease borrowing costs. Governments increase spending to stimulate demand. These policy responses are part of the machine, designed to soften the downturn and eventually restore balance. But most investors fail to see this cause and effect chain. They focus only on the immediate pain, falling stock prices, layoffs, reduced profits, and they miss the broader process at work. They forget that the same forces causing distress will eventually set the stage for recovery. For instance, lower asset prices make future returns more attractive. Lower interest rates stimulate borrowing and spending again. Fiscal stimulus puts money back into people's pockets. Over time, confidence returns, investment resumes, and the cycle restarts. If you're going to be a successful investor, especially in a recession, you must develop a deep understanding of these mechanics. You must analyze how credit cycles work, how liquidity conditions evolve, how central banks behave under pressure, and how fiscal policies adjust. You must recognize that while the media focuses on the noise of daily headlines, the underlying machine continues to move forward in predictable patterns, driven by human incentives and systemic pressures. The failure to see the economy as a machine leads most people to misjudge recessions. They see them as permanent threats rather than temporary adjustments. They sell in fear rather than buying strategically. But those who truly study the mechanics, who step back and watch the interplay of forces, are the ones who position themselves to benefit. They're not surprised by recessions because they've anticipated the imbalances that cause them. They're not paralyzed by fear because they understand that corrections are necessary to sustain long-term growth. And most importantly, they see recessions as opportunities to acquire assets that others are discarding in panic at prices that will appear extraordinarily attractive when the machine inevitably turns upward once again. One of the most common cognitive traps investors fall into during recessions is linear thinking. They take the current conditions, however bad they may seem, and project them straight into the future as if nothing will change. If GDP contracted this quarter, they assume it will contract next quarter by the same or even greater amount. If corporate earnings drop, they expect them to continue falling indefinitely. If markets decline, they fear they will keep spiraling downward. This way of thinking ignores the dynamic nature of how economies and markets function. It's a dangerous illusion that blinds people to how markets actually operate. Markets are discounting machines. They do not simply reflect where the economy is today. They reflect expectations about where it will be in the future. Every piece of information, every economic release, every earnings report, every policy announcement is absorbed into prices almost instantly. As a result, the bad news you're reading in today's headlines has often already been factored into market prices. That's why markets frequently bottom when the news still looks terrible. The worst moment in the economy often coincides with the beginning of a new upward move in markets because prices had already anticipated the bad news. And when reality turns out to be slightly better than feared, prices rise. This is why trying to time the market based on current economic conditions is so dangerous. You're always trading on old information. The person selling you stocks at a distressed price isn't doing so because they don't know the news. You both have the same headlines in front of you. The difference is in how you each interpret what is priced in and what might change going forward. The seller focuses on the current pain. The buyer focuses on the gap between expectations and reality. It's important to recognize that expectations can shift very quickly. All it takes is a minor policy shift, a slightly better economic indicator, or an easing of financial conditions for markets to adjust dramatically. For example, during severe recessions, central banks often lower interest rates aggressively or expand their balance sheets to inject liquidity into the system. Governments may pass stimulus measures that improve consumer confidence and spending. These policy responses can turn sentiment swiftly, even while real economic data still looks weak. Markets respond not to where we are, but to where we're going relative to where we've been. Understanding this is critical. If you allow yourself to be trapped by linear thinking, you will repeatedly sell at the bottom and buy at the top. You'll panic when others panic, and you'll feel safe when markets are already priced for perfection. The way out of this trap is to think in probabilities, not certainties. You must constantly ask, what is already priced in? What are the scenarios the market is currently assuming? What are the possible policy responses? What is the range of potential outcomes? The most successful investors are those who break free from linear projections. They understand that cycles bend, that policymakers act, that confidence shifts, and that markets lead the economy, not the other way around. They position themselves accordingly, prepared for multiple scenarios and ready to act when others are frozen by fear. To navigate successfully through recessions, one must embrace second-order thinking. Most people operate on first-order thinking. They see a negative event and immediately assume a negative consequence. Company profits are falling, stock prices must fall. Unemployment is rising, the economy must continue to deteriorate. This linear cause-effect thinking feels intuitive, but it ignores the complexity of how systems adapt, respond, and self-correct. It's precisely why most people lose money in downturns. They respond to what is obvious instead of thinking through the chain of consequences that follow. Second-order thinking forces you to ask, what comes next? What are others assuming? What actions will policymakers take? What expectations are already built into market prices? For example, when a recession begins, first-order thinkers panic because earnings reports are disappointing and layoffs increase. They focus on the immediate pain and sell their assets. Second-order thinkers, however, recognize that falling profits may lead central banks to cut interest rates aggressively, which will eventually stimulate borrowing and investment. They understand that fiscal authorities may introduce stimulus packages to cushion the downturn. They realize that as asset prices fall, expected future returns rise, making investments more attractive to long-term capital allocators. The key is recognizing that markets move not on absolute levels, but on changes in expectations. If everyone expects things to get worse, and reality turns out to be slightly better than feared, markets will rise. Conversely, if expectations are too optimistic and reality disappoints, markets fall. That's why recessions often create the widest gap between perception and reality. Fear becomes so pervasive that even marginal improvements can spark substantial rallies. Second-order thinking also requires understanding incentives. Policymakers are not passive observers of economic pain. They are highly motivated to act. When unemployment rises sharply, elected officials face immense political pressure to stimulate growth. When financial markets seize up, central bankers are compelled to intervene to restore liquidity. Understanding these incentive structures allows second-order thinkers to anticipate likely policy responses before they fully materialize. It's also essential to consider how different market participants behave under stress. Many large institutional investors are constrained by mandates that force them to sell during downturns, whether due to margin calls, risk limits, or investor redemptions. This forced selling creates dislocations where prices no longer reflect intrinsic value, but rather the urgency of sellers needing liquidity. Second-order thinkers see these dislocations as opportunities, not threats. Importantly, second-order thinking is not about blind contrarianism. Simply doing the opposite of the crowd isn't enough. It's about understanding what's priced in, evaluating the full spectrum of likely outcomes, and assessing where reality is likely to surprise the market. This requires deep research, historical perspective, and emotional discipline. Most investors fail to think beyond the immediate because it's uncomfortable. Second-order thinking requires embracing uncertainty, preparing for multiple scenarios, and having the confidence to act when opportunities arise amid fear. Those who develop this capability position themselves to capitalize on the mistakes of first-order thinkers, not because they are smarter, but because they see the entire chessboard while others are fixated on the last move. Recessions, while painful, are not equal opportunity destroyers. They act like powerful stress tests, revealing weaknesses that were previously hidden beneath the surface of rising markets and abundant liquidity. During the boom phase of the cycle, many businesses survive not because they are fundamentally strong, but because easy money and rising asset prices conceal their structural flaws. When the tide goes out, as it inevitably does, we discover who has been over-leveraged, mismanaged, or operating on unsustainable business models. The weak fall, but among the wreckage, extraordinary opportunities emerge for those who know where to look. The beauty of recessions, from an investment perspective, lies in their indiscriminate nature. Fear doesn't distinguish between the weak and the strong. As panic takes hold, investors sell across the board, good assets and bad assets alike. This broad-based selling creates what I call forced mispricings, where fundamentally sound businesses are dragged down with the failing ones simply because of generalized liquidity needs or herd behavior. This is where the disciplined investor, armed with liquidity and a clear understanding of intrinsic value, can step in and capitalize. It is crucial, however, to be selective. Not everything that falls in price is a bargain. Weak companies that are highly leveraged, structurally uncompetitive, or overly dependent on fragile business models may never recover. The key is to differentiate between temporary distress and permanent impairment. Companies with strong balance sheets, durable competitive advantages, capable leadership, and the ability to adapt to changing conditions often emerge from recessions even stronger than before. These are the assets that offer exceptional long-term value when purchased at distressed prices. In addition to individual companies, entire asset classes can become undervalued during recessions due to indiscriminate selling. Real estate markets may see sharp corrections as investors exit en masse, even in sectors where fundamentals remain sound. High-yield bonds may be sold off as investors flee credit risk broadly, even though certain issuers remain financially stable and capable of meeting their obligations. Equities may trade well below intrinsic value as earnings temporarily decline, even though the underlying businesses remain highly viable. To successfully identify these opportunities, one must combine rigorous bottom-up analysis with a top-down understanding of where we are in the cycle. It's not enough to spot a cheap stock. You must understand the broader context, credit conditions, policy responses, market sentiment, and liquidity flows. This integrated approach allows the investor to separate genuine bargains from value traps. Liquidity, both financial and emotional, is critical in these moments. The investor who has kept dry powder during the boom has the resources to deploy when others are forced to sell. But even more important is emotional liquidity, the ability to stay calm, analytical, and patient while others are gripped by fear. Those who can maintain this composure are rare. And because they are rare, they are the ones who consistently generate superior returns across cycles. The harsh truth is that recessions are necessary to reset imbalances created during expansion. They are painful for the unprepared, but profitable for the prepared. Those who have done the work in advance, who understand both the systemic and idiosyncratic risks, and who possess the discipline to act when others cannot, will be the ones who emerge from the downturn significantly stronger. When you're navigating a recession, the worst time to start thinking about how to respond is during the storm. By then, the winds are already howling, and the noise drowns out rational thinking. The people who come out of recession stronger, financially, emotionally, and strategically, are those who prepared ahead of time. Preparation is not reactive, it's proactive. It's the process of building resilience when things seem fine, so that when the cycle turns, you're not just surviving, you're in a position to capitalize. You have to recognize that downturns are inevitable. They're not rare events. They're built into the design of the system. Every period of expansion brings with it the seeds of contraction. If you know this and you accept it as a fundamental truth, you begin to operate differently. You don't stretch every dollar to chase short-term gains. You maintain buffers. You diversify across asset classes, geographies, currencies, and even economic exposures. Diversification isn't just a cliche, it's a practical defense against the unknown and unknowable. It's how you maintain optionality when others are boxed into one outcome. But preparation is not just about structure, it's also about mindset. When everyone around you is losing money, when the headlines are grim, when the markets are in free fall, emotional discipline becomes the rarest and most valuable commodity. Without it, all your plans fall apart. You can have the best investment framework in the world, but if you can't stick to it under pressure, it's useless. Discipline means sticking to principles you laid out in calm times, even when they feel uncomfortable in chaos. It means trusting your process more than your panic. Perspective is equally important. In the depths of a recession, everything looks worse than it is. People tend to overestimate the permanence of downturns. They think this time is different. But when you zoom out and study history, you see the patterns. Every crash, every recession, every panic, no matter how severe, has been followed by recovery. Sometimes slower, sometimes faster, but always eventually. Understanding this gives you the ability to think long-term when everyone else is short-term focused. And long-term thinking is the foundation of compounding. That's why scenario analysis is so essential. You can't predict exactly what will happen, but you can prepare for a range of outcomes. What happens if rates stay low for longer? What if inflation spikes again? What if growth stalls, or what if a recovery is faster than expected? When you prepare for multiple paths, you're not betting on being right. You're positioning to survive and thrive, regardless of which way the wind blows. The reality is, most people don't do this. They chase returns during good times, overextend themselves, and then react emotionally when the cycle turns. But those who are truly prepared, structurally diversified, emotionally grounded, and philosophically anchored have an enormous edge. They can buy when others are forced to sell. They can think clearly when others are consumed by fear. And most importantly, they understand that cycles are opportunities, not threats, if you're prepared. In the end, what separates successful investors from the masses in a recession isn't brilliance or luck. It's an understanding of how the economic machine works, a deep humility toward the inevitability of cycles, and a disciplined approach to preparation and decision-making. While most people let emotions cloud their judgment, reacting to the immediate pain and fear, those who remain calm, think in probabilities, and act on second and third order consequences position themselves to benefit from the very mistakes others make. Recessions are not anomalies to fear, but integral phases that offer some of the most attractive opportunities for those who are prepared to see them through a lens of system-based thinking, emotional discipline, and long-term perspective.